Today we are taking a close look at an important development from Vietnam's foreign exchange market and discussing why Iraqi dinar followers should pay attention to it. While this update is centered on the Vietnamese dong, it provides valuable insight into how central banks manage exchange rates, maintain financial stability, and guide their currencies through changing economic conditions. These are the same types of monetary principles that many investors and analysts examine when evaluating the future direction of the Iraqi dinar and broader currency reforms. Vietnam State Bank has announced that the daily reference exchange rate has been set at 25,338 Vietnamese dong per US dollar for July 31, representing an increase of 18 dong compared to the previous trading day. At the same time, the central bank continues to maintain its established trading band of plus or minus 5%. Under this framework, commercial banks are permitted to trade within a ceiling rate of 26,605 dong per dollar and a floor rate of 24,071 dong per dollar. Meanwhile, some of Vietnam's largest commercial banks, including Vietcombank and BIDV, opened the trading day with slightly lower buying and selling rates than the previous session. Both institutions listed the buying rate at 26,090 dong per US dollar and the selling rate at 26,470 dong per dollar, each declining by 50 dong from the previous day. At first glance, these movements may appear relatively small. However, for those who closely follow international currencies, these daily adjustments provide valuable information about how a central bank manages stability, while allowing market forces to play a controlled role. Rather than permitting sudden and unpredictable currency swings, Vietnam continues to demonstrate a carefully managed exchange rate policy that balances domestic economic priorities with international financial conditions. For Iraqi dinar followers, this serves as another reminder that exchange rates are rarely determined by speculation alone. Instead, they reflect a combination of monetary policy, foreign exchange reserves, inflation expectations, international trade flows, capital movements, and overall economic confidence. Every central bank has its own policy framework, but many of the underlying principles are remarkably similar. One important aspect of today's announcement is the distinction between the official reference rate established by the State Bank of Vietnam and the actual buying and selling rates offered by commercial banks. This difference exists because the central bank provides guidance for the market, while individual financial institutions adjust their prices according to customer demand, liquidity conditions, and daily market activity. This same concept is familiar in many countries, including Iraq, where official exchange rates and market exchange rates have historically differed depending on policy objectives and market conditions. Over the past several years, Iraqi authorities have devoted considerable attention to narrowing the gap between official and parallel market exchange rates in an effort to strengthen monetary credibility and improve confidence in the financial system. The Vietnamese update also highlights another important characteristic of modern central banking. Even though the reference rate increased modestly, commercial banks reduced both their buying and selling prices. At first glance, that may appear contradictory, but financial markets frequently operate this way because commercial institutions respond to immediate liquidity conditions, while central banks establish broader policy direction. Currency markets constantly process enormous amounts of information. Interest rate expectations, import demand, export performance, international investment flows, and even geopolitical developments can influence daily trading activity. Commercial banks therefore adjust their quotations according to current market conditions, while remaining within the regulatory boundaries established by the central bank. For those following the Iraqi dinar, this illustrates why daily exchange rate movements should always be interpreted within their broader policy context, rather than viewed as isolated events. A single day's adjustment rarely signals a major long-term shift by itself. Vietnam's exchange rate system also demonstrates the importance of predictability. By maintaining a clearly defined trading band, the state bank provides businesses, exporters, importers, and investors with a stable framework for conducting international transactions. Predictability helps companies manage financial planning, reduces uncertainty, and supports long-term investment decisions. This principle is highly relevant when discussing Iraq's own monetary modernization efforts. One of the objectives frequently discussed by policymakers is strengthening confidence in Iraq's banking sector. and improving financial transparency. Stable monetary policy helps businesses plan ahead, while supporting broader economic reforms. Another noteworthy element of today's report is the relatively modest size of the adjustment. An increase of just 18 dong in the official reference rate represents careful policy calibration rather than dramatic intervention. Central banks often prefer gradual adjustments because abrupt currency movements can disrupt trade, increase inflation risks, and create unnecessary volatility in financial markets. Gradualism has become a common feature of monetary policy across many emerging economies. Rather than seeking dramatic exchange rate changes, policymakers generally prioritize stability and confidence. Financial markets often reward consistency more than surprise. For Iraqi dinar observers, this reinforces an important lesson. Currency values generally evolve alongside broader economic reforms, rather than through isolated announcements. Fiscal discipline, banking modernization, foreign investment, infrastructure development, energy exports, regulatory improvements, and institutional credibility all contribute to the long-term outlook of a nation's currency. Today's Vietnamese data also reflects the ongoing importance of the US dollar within the global financial system. The dollar remains the primary currency used for international trade, commodity pricing, and reserve management. Consequently, even modest fluctuations in dollar strength can influence exchange rates around the world. Central banks therefore continuously evaluate global developments when determining domestic monetary policy. Decisions made by the U.S. Federal Reserve regarding interest rates, inflation control, and liquidity conditions often have indirect effects on emerging market currencies, including both the Vietnamese dong and the Iraqi dinar. When U.S. interest rates remain relatively attractive, capital can flow toward dollar-denominated assets, placing pressure on emerging market currencies. Conversely, changing global financial conditions may create additional flexibility for central banks managing their exchange rate frameworks. This interconnected environment explains why currency analysis requires looking beyond domestic developments alone. International financial markets, commodity prices, trade balances, foreign direct investment, and geopolitical stability all influence currency performance over time. Vietnam has earned recognition over recent years for maintaining relatively disciplined monetary management while supporting rapid economic growth. The country has become an important manufacturing hub, attracting international investment across electronics, technology, textiles, and industrial production. These structural strengths contribute to demand for the domestic currency, while also increasing the need for careful exchange rate management. However, policymakers must balance several competing priorities. A currency that strengthens too rapidly can reduce export competitiveness, while excessive weakness may contribute to imported inflation. The objective is not necessarily achieving the strongest possible currency, but maintaining one that supports sustainable economic growth. This concept often generates misunderstanding among retail currency observers. A stronger currency is not automatically better under every circumstance. Export-oriented economies sometimes benefit from exchange rate stability that allows manufacturers to remain competitive in international markets. Similarly, Iraq's policymakers face their own unique set of economic priorities. Iraq's economy is heavily influenced by oil exports, government spending, banking reforms, and efforts to diversify beyond hydrocarbons. These structural characteristics differ significantly from Vietnam's export-driven manufacturing economy, yet both countries rely upon credible monetary institutions to maintain financial stability. Another point worth discussing is the role of commercial banks in transmitting central bank policy. Today's report shows that even though the official reference rate increased slightly, major commercial banks adjusted their own exchange rates downward. This illustrates that banks continuously evaluate customer demand, liquidity management, and competitive positioning. Commercial banks serve as an essential link between monetary authorities and the broader economy. Their pricing decisions affect importers purchasing foreign goods, exporters receiving international payments, businesses financing operations, and consumers exchanging currencies for travel or commerce. For Iraqi dinar followers, understanding this relationship helps explain why official policy announcements do not always produce immediate identical movements throughout the banking system. Market participants interpret policy signals differently depending upon prevailing financial conditions. Looking at the short-term implications of today's Vietnamese announcement, the overall message appears to be one of continuity rather than significant policy change. The state bank continues to operate within its established exchange rate framework, while allowing measured adjustments that reflect evolving market conditions. Commercial bank pricing also indicates orderly market behavior, without evidence of unusual stress or excessive volatility. Such stability generally supports business confidence and reduces uncertainty for companies engaged in international trade. From a regional perspective, stable exchange rate management contributes to broader investor confidence across Southeast Asia. International investors often evaluate institutional consistency when allocating capital among emerging markets. Predictable monetary policy can therefore become an important competitive advantage. Turning back to Iraq, observers continue monitoring developments related to banking modernization, digital payment expansion, anti-money laundering reforms, improvements in financial transparency, and efforts to strengthen international banking relationships. These structural initiatives are widely regarded as important components of long-term financial development. While today's Vietnamese exchange rate announcement does not directly affect Iraq's currency, it offers a useful example of how central banks communicate incremental policy adjustments. Financial markets often respond positively when authorities maintain transparent and predictable policy frameworks. Long-term currency performance is typically linked to productivity growth, fiscal responsibility, institutional strength, external competitiveness, and investor confidence. Daily exchange rate announcements provide snapshots of policy implementation, but they represent only one element within a much larger economic picture. For viewers interested in the Iraqi dinar, this serves as an opportunity to focus on the underlying fundamentals that influence currency stability over extended periods. Banking sector modernization, improvements in payment systems, stronger regulatory oversight, foreign investment, infrastructure expansion, and continued economic diversification all contribute to the environment in which monetary policy operates. It is also important to remember that central banks frequently make small adjustments that receive limited public attention, but collectively shape long-term economic outcomes. Monetary policy is often more evolutionary than revolutionary. Today's Vietnamese data illustrates precisely that principle. A modest increase in the reference exchange rate, combined with slight adjustments by commercial banks, reflects routine monetary management rather than extraordinary intervention. Such gradual adjustments help preserve confidence while allowing markets to adapt smoothly. Financial markets generally value consistency because predictable policy reduces uncertainty. Businesses making long-term investment decisions often prioritize stable economic environments where monetary authorities communicate clearly and implement policies steadily. This lesson applies broadly across international financial systems. Whether examining Vietnam, Iraq, or other emerging economies, investors and analysts typically monitor inflation trends, reserve levels, fiscal performance, banking reforms, trade balances, and institutional credibility alongside exchange rate movements. Another important takeaway is the distinction between speculation and verified policy announcements. Responsible financial analysis focuses on official statements, published economic data, and observable policy actions rather than unsupported rumors or unrealistic expectations. That disciplined approach helps viewers develop a more informed understanding of complex monetary issues. For Iraqi dinar followers specifically, remaining informed through credible sources and official developments remains essential. Currency reforms, when they occur in any country, are generally accompanied by broader economic measures rather than isolated exchange rate adjustments alone. Evaluating the overall policy environment provides a more balanced perspective than focusing exclusively on short-term market speculation. As we continue following developments across global currency markets, updates such as today's announcement from Vietnam provide valuable opportunities to compare different monetary frameworks and understand how central banks pursue stability under varying economic conditions. Although each country's circumstances are unique, the principles of disciplined monetary management, transparent communication, and gradual policy implementation remain widely recognized throughout international finance. In the coming weeks, analysts will continue monitoring Vietnam's exchange rate policy alongside broader global developments, including international trade trends, inflation data, interest rate expectations, and financial market conditions. These factors will help shape the operating environment for many emerging market currencies. Likewise, observers of Iraq's economy will continue watching official announcements related to banking reforms, economic diversification, fiscal policy, and financial sector modernization. Each development contributes another piece to the broader picture of Iraq's evolving economic landscape. The most constructive approach for currency followers is maintaining a long-term perspective grounded in verified information and sound economic analysis. Daily exchange rate changes are informative, but they should always be interpreted within the wider context of national economic policy and global financial conditions. Thank you for joining us for today's analysis. If you appreciate responsible, balanced, and factual coverage of Iraqi dinar developments, global currency markets, and economic